My name's Nigel May from MHA. I'm joined this afternoon by my colleagues Patrick King and Tony Metcalf to talk about today's budget. We have done a session that is separately available concerning the sort of big picture aspects of today's budget, and the purpose of this session is to look at some of the more significant tax changes that were announced, or in some cases were not announced, but nevertheless are coming down the track. You know, just to see what we think about these and what the prognosis is. Whilst not directly a tax issue, one of the major things that came out of today's budget, which had been largely briefed beforehand, was the preservation of various COVID-19 protection measures and incentives. And you know, the one major tax issue in there is the stamp duty land tax relief that was brought in to increase the SDLT threshold for residential properties to £500,000. Tony, I think it was expected. Any thoughts as to this and how people should be acting?
Yes, as you've said, it was largely pre-briefed, and you could see that there was a lot of discussion about an impact on transactions and therefore an impact on prices as a consequence of people having to fall out of transactions, etc. So I think the Chancellor did the right thing. He extended the period in which you have the exemption up to 500,000 from the 31st of March to the 30th of June. But secondly, what he did do, he then actually tapered it away. So taking away that sort of precipice feel that it's all or nothing. So in the following 3 months, from the 1st of July through to 30th September, that limit was reduced to 250,000. So there was no stamp duty up to 250,000 on residential purchases. And then from the 1st of October, that reverted back to the normal 125. So I think that was a good measure. And I think it's important to, when you're easing people back into normality, actually stage it. And so it was a good measure.
And Patrick, we still have surcharges to think about for SDLT purposes, don't we? We've got the 3%, but we also, and it's easily forgotten, we've got the non-resident SDLT surcharge coming in from 1st of April. I mean, these are desperately unpopular, I think, with clients, and in particular, the 3% surcharge can be quite complicated. Have you any thoughts, perhaps, if one is looking at it from the buy-to-let sector and things like that, as to action to take?
Well, in terms of the offshore buyer and the additional, I think it's 2%, isn't it? The extra charge for offshore buyers. The experience we've had so far with people looking at UK property is that they see the UK still as a very attractive place to put some money in terms of property. Our property market has been strong continuously for a very long period now, and isn't really showing any signs of slowing down. So I don't think another 2% is going to make a huge difference. One area I did notice made a difference actually was the changes to our inheritance tax rules in UK property, which had an impact on some people I was dealing with in terms of investment here. But no, I don't see that as making a significant change to the activity of offshore investors.
And one of the practical points that struck me was, I can't remember if it was the Law Society, but there certainly were releases from the legal profession about the strain on conveyancing solicitors and you know, how you have to get in really quite quick if you're going to get practical completion through by these deadlines. So I would have thought one of the major lessons from this would be don't leave things to the last minute, because if you're trying to get in before the 30th of June deadline, the transaction will have to be underway some way before that.
Yeah, absolutely. I mean, we know these things take time. Every time you've moved house, those of us that have moved once or twice, you know how long it takes. It always takes longer than you expect, and there's no reason to think it'd be any different in a buy-to-let or an investment decision. So yes, give yourself time.
Yeah, I think that's important. So if we move on to the mainstream tax announcements in today's budget, the first thing that sort of jumped out, but again largely pre-briefed, is the increase to corporation tax rates. And to be fair, Tony, do you want to comment on that first? And maybe Patrick, would you like to comment on the loss relief changes? So we've got one bit of bad news and one bit of good news.
Yes, the rates currently 19% for all companies are briefed to go up to 25% from the 1st of April 2023. So that's quite a significant hike. Mr. Sunak did mention that that's still one of the lowest within the G7. But I think it was larger than I was anticipating. I was probably expecting it to maybe graduate up to 22, 23%. To protect the majority of smaller businesses within the economy, we've reintroduced the delights of small profits being taxed at the 19%. So any profits for any company up to £50,000 are taxed at 19%, and then we have the delightful marginal rate relief calculation that broadly takes the rate up to 25% as the profits for the business get to 250,000. So complexities come back, and I think that but it's not something that we've not been used to. It's just taking us something back to days of old. There were changes also to the number of the way they calculate associated companies for payment of tax as well, rather than the normal 9 months after the year end. Some companies fall within the quarterly payments on account. So I think that there are changes there, bringing in wider associated companies to catch probably a more up-to-date tax payment profile for businesses. So I said not largely unexpected, but maybe the hike of increase probably was.
Again, we were talking just before about transactions and what have you. It seems to me that with this hike, and like you say, it is a large hike in tax rates. Certainly, if you've got companies that are looking to realise chargeable gains, presumably they should be looking to accelerate that profile to make sure that they fall on the right side of the line, and look at their accounting periods as well.
Yeah, very much so, because that really is a precipice. We've got the introduction of a 6% hike in rates happening on one day. So I think any transactional work, there'll be a lot to think about over the next couple of years for many of our corporate clients.
And Patrick, losses.
Well, yes, on the losses, this was perhaps a bit more of a surprise, but quite a welcome one. What the Chancellor's announced is that for the next 2 years, up to £2 million worth of losses can be carried back, not the usual 1 year against previous years, but back 3 years. So what this will hopefully do is businesses that were working quite successfully prior to COVID, but have struggled during it for being closed and so on, maybe making losses, can carry their losses back up to 3 years and therefore potentially get a refund to get them started again. So that really is quite generous. It's a 2-year period. We're not quite sure how all the rules are going to work yet, but it is quite a generous relief and to be welcomed.
Again, we have been there before, haven't we? In previous recessions, we did for many years have a 3-year carryback, but that's going back into the dim and distant past now. But it could be genuinely cash generative for the right format of companies, depending on the detail, of course. Sort of associated with this, we've got the new, much vaunted as of this afternoon, Super-deduction. What is this? What are we dealing with here?
If I may interject there, I mean the super-deduction is an enhanced tax relief available to companies over the next 2 years. to invest in plant and equipment. So whether that be movable plant and equipment or equipment within within buildings, etc. So in some respects, trying to prize money out of their bank accounts and invest, and obviously that, you know, investment drives growth. So in that instance, what it does is it allows 130% relief for expenditure for plant and equipment, or 50% for those items of plant that are situated in the special rates within buildings, etc., structures, and that is fully deductible against the profits of the business. So you know, that is obviously over the next 2 years. The corporation tax relief then drops in, you know, after that. But a welcome shot in the arm, and there's much discussion as to you know, the interaction that we currently have with the annual investment allowance, which is currently £1 million, but that's due to fall to 200,000 from the 1st of Jan next year. So it's a welcome step there from Mr.
Sunak. If it results in losses, as to whether that can be included in the 3-year carryback as well. One assumes that it can, but there may be restrictions there, perhaps.
Okay. No, it's been heralded as the greatest corporate tax cut in British history. I'm not quite sure where that came from, but you know, it's obviously designed to change behaviour and to get money spent into the UK economy. And again, maybe that's a little bit of a recurring theme, that let's get the economy started, and you know, companies that have accumulated cash spend it in the economy and get the money flowing around.
Just on that, Nigel, I think there's a lot of talk about our headline rate being very, very low, and it was 19%, but it was the lack of investment, and therefore the lack of tax reliefs for that investment, that actually, when you look at us in comparison to, you know, other economies around the world, we sort of sat in the middle, really, with an effective tax rate of about 23%, because they had much more aggressive tax relieving provisions for investment for growth, which is a welcome change. We've actually moved, you know, into that arena now. So I think it's, as I said before, I think it's a welcome step.
I think, Tony, that you know, you're, number one, you're spot on. Number two, though, what a difference a few years make, because, you know, we were going to be paying corporation tax at 17%, if you remember. So to be in a position where the corporate tax rate has gone up from an expected rate of 17% to an actual rate in a few years' time of 25% is radical. It does make doing the maths easier, though, doesn't it? 25% is far easier than 19%. I suppose be grateful for small mercies so far as that's concerned. Again, much heralded or pre-announced is the matter of Freeports, and these seem to me to be a term of art, with different meanings in different jurisdictions, but they're a new one for us. So, Patrick, what's the benefit of a Freeport?
Well, I mean, all the rules aren't available to us yet, but I mean, it looks as though they're going to have a number of benefits. There will be significant duty benefits. It would appear that you can import goods into a Freeport and pay no UK duties, do processes upon it, and manufacture products with those items, and then you only pay UK duties if you take them out of the Freeport into the UK economy. But if you export them, then no UK duties are paid at all, which is quite a nice benefit. There'll be no stamp duty land tax, as far as we can see. So if you're buying premises within a Freeport area, then there'll be no duties, no tax.
Presumably, that only applies to commercial property.
I think so. Yes, it's your trading premises, exactly. And we believe there's some relief for national insurance as well. So presumably that there's encouragement to take on employees. It's going to be cheaper to do so. So they certainly do seem to have a number of advantages. What they don't seem to have is a lower headline rate of corporation tax, which is obviously used in other parts of the world in some cases. So we're not going that far, and that may be a result of negotiations with the European Union, perhaps. I'm not sure.
And it seemed from the speech that these 8 Freeports announced, maybe just the first 8 of several. Now, I don't know whether that was reference to Freeports that will be emerging in Scotland and Wales, or whether we're expecting more Freeports in England.
Well, I think from looking a bit more, the Freeports are areas within which there will be tax sites, and those are the bits that are going to be up for grabs from September. They're going to be inviting people to claim tax sites within a Freeport area. But certainly they're also looking to have Freeports. They want to have at least one in each of the home nations. So the 8 announced are all in England, and presumably in due course we'll have at least one in Scotland, Wales and Ireland.
And just to carry on the investment theme there, Patrick, just to pick up on one of the other reliefs, they did mention the extension of capital allowances for, again, investing in those areas with enhanced capital allowances and an extension of the release available for people buying and investing in industrial buildings. So I think that those people in the Freeport areas will see quite a significant long-term benefit for making those investments. So the comment about a reduced corporation tax rate, in some respects, I suppose the idea there is that you invest, you spend the money, and you'll see the lower corporation tax rates by the various reliefs that we've brought in. So very positive.
Which goes back, Tony, to what you said about other jurisdictions and having a more relief-focused system of corporate tax. Yeah. Okay. So always with budgets, there's the point of what has not been said, what has not been announced. Patrick, to you first. What did you see coming that didn't emerge, or do you feel that you got the call right?
Well, I think we've been there's been an awful lot of speculation about increases in capital taxation over the last year or so, hasn't there? A lot of reports have been produced suggesting there may well be changes in inheritance tax and capital gains tax, and most recently it looked like capital gains tax was clearly in the sights for change. With the explosion of COVID again earlier this year and end of last year, it did begin to look like perhaps this budget would be focused more on the relief and the growth side, which is exactly what we've got, of course. And certainly what I've been saying to clients is we do expect these capital tax changes, but maybe not as early as March. And it looks like from that point of view, we got that right. But I think it's fair to say we can expect those changes in the not too distant future. And the other big area, of course, is pension relief, where for years now, all of us have probably been telling rooms full of people, get your pension relief while it's going because it won't be there for much longer. It still is there, but again, you have to assume that there could be a grab there at some point in the future when the government thinks it's appropriate.
And Tony, if we look at where we go from here, and obviously there's an awful lot of devil in the detail to come out, but we've got various consultations and what have you that you know, we know government is looking at various things. You know, if we wind the clock forward, when do we think we're next going to hear from Mr. Sunak?
Well, we've got into the cycle of having a November statement, and obviously for this last year just gone, it had to be cancelled as a consequence of the second lockdown and the resurgence of the coronavirus. So in some respects, this budget really has been not as I expected it would have been in November. So I would think the next one will be in November. I think by then they will, again, talking about the macro side, probably have a clearer picture of how the economy is doing, how we've come out of the restrictions, and therefore some of the more technical, more structural changes that Patrick alluded to, that have been touted around, that the government have had a number of reports done by the Office of Tax Simplification. I think it will be time to look at those on a more structural basis, maybe November or the following year after that. So they're more involved for the likes of us as tax advisors, because it's very much more on the intricacies and the workings of reliefs in relation to various taxes, in particular capital taxes. Rather than the big economic picture that he needed to push out there in this budget. So I think that we might well be expecting another statement, at least in late autumn, November.
So the lesson is, don't just assume that things will stay as they are just because they've not changed now. That there's still a sort of like a window between now and sometime in November where if you want to bank the current rules, you should be acting. That must make sense, mustn't it?
I think it must do. Yes. I mean, the Chancellor, as we discussed earlier, there hasn't been a significant attempt so far in terms of reducing debt. It's more a case of getting the current account under control and then keeping things fairly steady and letting the debt sit there for a long term. Given the likelihood of increased interest rates over time, at some point you'd have to think there's going to be an attempt to address the size of the deficit, and that means raising more taxes. In a time when you're trying to recover, you can't raise taxes really from the majority of the population on income and so on. So capital taxes seem to be the obvious place to go because you tend to be targeting people who can better afford to pay a little bit more.
Okay. Well, thank you, Patrick. Thank you, Tony. I hope you've found this useful. Like I said at the outset, there's a separate one dealing with the big picture economic aspects of the budget. As I say, I hope you found this useful. Details of our budget coverage is available on our website, which is www.mha-uk.co.uk. There will be full details there. And I just stress that the devil is in the detail on these sort of things, and quite often additional information comes out after budget day that may add a different nuance to what first impressions are given from what is released on budget day itself. So there's no substitute for proper advice. So please do not hesitate to contact your MHA representative if you need further information on the issues that we've talked about this afternoon. Thank you very much. My name is Nigel May from MHA.